This is London with MarketHedge. Let's pay attention to Bitcoin and make the case for a hit at this level. This is London, former hedge fund owner. We'll talk about heavy cash reserves. We'll talk about not being overexposed and what's trading well on Bitcoin. In the meantime, I want you to take the daily chart. Please line up this $25,000 specific rounded pivot here, 25,000. Please line that up with the $50,000 metric here, that $50,000 rounded, part of the bull flag, but rounded pivot there. So pivot 1, 25,000, pivot 2, 50,000. You'll see Bitcoin's coming into contact with this line. Now, this is the second trend line that we have been focused on. I want to show you guys the primary trend line we've discussed. It doesn't get any clearer than this blue line up across the top, which is already given away. But we do have, and I want to show you guys, we do have this as a backup. This happens as we try and find pretty much hang-ons for the bulls to grab on and get some traction at some point. We'll continue to maybe stretch this line. We don't want to stretch it any further. You guys know if we really start to stretch it even further, this is what starts to happen. We're just going to lower and lower levels. But does not discount the fact that given these two strong pivots, the first at 25, the second at 50, we are at a contact zone. And there along with, very importantly, if we're looking at the specific level of resistance across the top, if we were to just pull down, which is a metric by the New York Institute of Finance, we're literal Wall Street traders, guys, Wall Street traders at big institutional desks. That's where investment banking desks. That's where, guys, they go to school. So if you want the real answers, look at New York Institute of Finance. That's the keys on Wall Street. So looking at the specific carry down, parallel carry down from resistance to support, this is another, guys, good rationale for not only a target at this level, but also some interaction, which we're already seeing. I want to pull into scope as well. The monthly is on the Bollinger Band, going to show us an additional level that is really, really close. Let me get rid of this secondary or backup trend line that we found. And I want to shout out to all the VIP, guys. Congratulations to all the VIP who are trading. J-Mac, nice to see you trading in the back. Luke, I hope you're trading, brother. And Daniel, nice to see you trading in the back. It's very successful day today. I'll talk about that here in just a moment. Looking at the monthly mid-level of the Bollinger Band is the 20 moving average. We see a near hit. We really don't like near hits. We like contact. We're a full contact sport level of day traders here. That's what we like, is nice, good, even contact. We didn't get it on USDT. We didn't get it on USD either. So we're still left a little in a questionable zone here, as that's a primary target. Now notice we were off of the primary target, that 20 moving average on the monthly precedingly, but it's just so close. We'd really, really like to see a contact with that monthly. If you back test it, you'll just see that being over the monthly has been bullish and being under the monthly has been bearish. Noting that standard deviation to the downside, absolutely, guys, that ended that 15,500 low before taking off to 125,000. So with a quick rebound here, it's just close, guys. That 20 moving average, don't leave that off your radar. If we are powering down even a little bit more, we may get some additional, and we're noting now, some additional reason or justification for a contact in this zone, aside from the other metrics that we've pulled up. Now, what is trading well? This may get a little complicated, but I want you guys to relax, pay attention. What is trading well on Bitcoin? RSI, low, 4 hourly. You guys know that. We pay attention to the RSI, the relative strength index. That's Wilder's formula, right? Oversold, right? Means the sellers have engaged a bit too much potentially, though they can keep selling. You guys know that. If we're overbought, oversold will be under 30. Overbought is over 70, right? And that's, well, the buyers have really bought, and relatively, it's going to be a relative strength index, but relative to preceding performance, relative to the recent history of number of bars or intervals, we are overbought relatively to that. So buyers have engaged in overbought, sellers have engaged in oversold. Where are we now? And the levels that we look at are the low RSI, meaning that 30 line, and I have them lined out on the different time frames, but they're multi-time frames shown on the actual price chart. So it's extremely advantageous for us to see on the price chart, which you can extrapolate from Wilder's formula, and not just in an oscillator. If you read any book, you're going to see The oscillator is going to be presented to you as the metric to watch. I don't care for the oscillator because you always have to look away from price. You're looking at the price line, and then you have to look down, and then you have to reconnect with price without this specific indicator in place. So as we look at the 4-hourly low or 30 and the daily low or 30, what we're looking at are just nice trades. These were excellent trades today in the back. Multiple guys, really great trades. I can say that, but when you look at guys, when you're in the back and you see some really nice trades coming through, if we look at the just the daily results here, multiple accounts doing what was this? Multiple accounts over 30K, trading 8 or 9 wide, most over 20K. Just a nice day in terms of pickups. And what was the trading strategy? I laid it out yesterday to everybody. It's no secret. You guys know I laid it out to you. It was stacking orders under the specific 4-hourly low, meaning when we get to low, when we get to the low level or the low that low target level reading 30 on the RSI, what do? Well, when we get there, we stack orders underneath. We get the recoup. When it goes down, we're looking for a recoup at least to that 4-hourly low RSI. What's that going to look like on the oscillator? It's going to look like this. You see, we're going to go down below the reading of 30, which is oversold, and we're going to catch that trajectory, bam, back to the upside. Now, holding on to it, that's going to be another story. That's up to you if you want to hold that position. And this is actually the 4-hourly here on the 4-hourly time frame. You see that now. I'm seeing that 4-hourly regardless of what time frame I'm on, so I have the benefit of using lower time frames and still seeing my 4-hourly, my higher time frame reading, right? Maybe a little confusing if you're new to the game, but if not, just stick with it. This is the 4-hourly time frame. Obviously, the daily time frame, you'll see that oscillator is down in the oversold turf. That means exactly what you see here as well, right? That daily oversold is currently where price is at. So we're equivalent, we're on par with the oscillator and the specific line above. And yes, I just want to reinforce this. What is paying and how is it paying when we're going down? And it's been consistent the last number of weeks. This may not look very good to you. It has been bang on. It has been beautiful trading. It's been fantastic as we look at the trades being set here underneath that specific 4-hourly. I can repeat this at every single hit, and I will tell you every single hit has indeed paid for the recoup back to the specific 4-hourly low RSI. So that's been the key metric and focal in terms of the technical that we have been trading on in the back. And I just tell you, it's not just me. J-Mac, way to trade in the back. Nice to see you taking advantage of this. We call this a hedge. Why? A few different reasons. First of all, if we're hedging, it's an asymmetric move. So instead of shorting here and trying to just level in with the bears and saying, hey, we're heading down, it's an asymmetric move. So we're looking to catch this move, but really our action is going to be back to the upside. So we're going to catch a throwback move, bam, meaning we're operating against the action in the market. So it's a hedge. We're operating against that action in the market every time, setting longs underneath the specific breaches on that 4-hourly. Then why else is it called a hedge? Because at every level of this specific set of orders, this batch of orders, we're not putting full margin in at every single level. In fact, we're distributing the margin, right? Or we're dividing the margin by the number of levels. So if it only comes into the first couple of levels, we're not fully exposed. If we were to get a huge move to the downside, let's say just an absolutely massive breach on Bitcoin, like we had a number of Fridays ago. You guys recall that big market dump. It was just a bad move, a dramatic move to the downside. Well, this was a situation, that would be a situation where we're hedged in that we don't have full exposure at any one of these levels. In fact, we're predeterminatively, we are dividing, and I'll say this, normally I like about a $3,000 is good. $3,000 of margin is nice, and I'm spreading the margin of the orders rather over $3,000, not just the margin, but yeah, we're looking at the number of orders over. Now pay attention, guys, but the number of orders over a specific range. So if I'm looking at 3,000 and I'm looking at, let's just say that I were looking at 3,000 and I had 10 orders, that would be orders at every $300 increment, right? If I want to get more aggressive with that and put 100 orders in, that would be an order at every $30 increment. Really easy, guys. It's 3,000 divided by what? I want 100 orders. Great. 100 orders divided by 3,000 would be 30. You got it. So as we look at that, you would say, well, why would I want that many orders? Because I can spread margin into those orders. Also on multi-account, I can bypass the restrictions or the limits on my margin, and it makes these trades really, really something interesting to look at. In terms of the risk, I'll tell you, we trade with BTCC, and we're always looking for accelerated risk and accelerated returns, bottom line. So hope you guys paid attention to the early part of this video. If you're still with me, congratulations. That means you want to learn how to make money. And I'll just tell you, if you're in the market and you're not making money, man, I just want to tell you that I don't know how else to tell you. These are solutions to making money. And if you're not willing to try the solutions or open your mind, and you're still fixated on what you're doing, if you just made money, go for it. Go rock and roll. Enjoy it. And you tell me, you can sit me down in our group and tell us how you're making money. Nothing would thrill me more, I promise you. But if you just lost money on the way down or otherwise, and you're not really synced in the market, rewind this, pay attention to this, make sure you sync through this. Guys, get great white shark level of a bite into this information and make sure you master it. Make sure you understand it. Make sure you could conceive, go through AI, run through the figures. Say, okay, fine. What if I put in 100 levels over $3,000, right? And I put at each level $400 in margin and 400 in terms of leverage. Let's just see. Get your specifics down in terms of where you'd start, where you'd end up, where you'd return to, and look at your returns. It doesn't maybe do you much good to look at a return of 20 or 40 or 60 or 80 or 100 or 200 or 300 or $400,000 if you're not zoned in and paying attention to what is creating that amount in a trade. I want you guys to know it. That's why I'm spending time going through it with you. I want you to know it. And if you don't know it, and like I said, if you got something better, rock and roll with it. Drop me a line. Let me know in the comments what you guys are up to. Otherwise, stacking orders, and the key is going to be at a discernible level of interest to where the back testing proves that it is a solid level of consistent interaction in either the throwback territory or an actual rebound mechanism. If you look at the 4 hourly, you'll just see consistently that the metric is there to go ahead and hedge that line. Now, the exception and the need for the fallout in terms of the potential risk factor, bam, that was a big move. That was a couple of Fridays ago. We went through it, discussed it, talked about it. Yeah, $12,000 move. Absolutely. That was a washout. If you got washed out, you got to be prepared for it. Never risking more than you're willing to lose on any specific trade. Guys, it's London with MarketHedge. Wanted to spend a little extra time with you and go through the details. Let's see how this interaction is. And I spent time on this 4 hourly low RSI and on the daily low RSI here, just so we would not go through this level of a trade, just say this level of trade success in the back, and with me, without you guys knowing exactly what I'm doing. That's what it means to me, guys, to have a trade group and to have a community. So I'm just doing that as a matter of fact. I hope you guys are having a great start to your week. This is London. Let's go. Let's kick up the energy, and let's see if we can hold this line. Guys, that specific 20 moving average is a hot target. Would love to get some action there. We'll be trading in the back. Drop me a line. Appreciate all your time. This is London with MarketHedge.